All right, hopefully you guys can see my screen. Tim Davis here again. Wanted to record another quick video to continue to add some more content to my YouTube channel. And this one is going to be titled, "Is there a market crash looming?" Is there a market crash looming? That is a huge possibility. And let me show you why, why I feel the way I feel. So take from it what you wish. But this is the reason why I feel the way I feel, and I'm going to share it with you guys. Okay. All right. So, and I'm just going to focus on paying attention, looking at the longer term quarterly chart of the futures market of the S&P, Dow Jones, and the Nasdaq and the Russell. All right. I want to point out something, and you guys who follow me, you always know that I always pay very close attention, especially on the longer term charts. The quarterly chart, I'm sorry, the 50-day moving average and the 200-day moving average, just to see where price action is in relation to the moving averages. So for that purpose, I'm going to let you guys know what my 50-day is. My 50-day is this blue line here, 50-day moving average, and the red line is my 200-day moving average. Now, on all time frames, the moving averages, especially the major ones like the 50 and the 200, they act as price magnets. Price does not like to be too far off from the moving averages. So for this quarterly chart, I'm looking back over the past 20 years, and I'm gonna point out something here. You tell me if I'm, if seeing something incorrectly. All right. Now, I want to point out over the past 20 years, we have really not seen a check back to the 200-day moving average on the quarterly chart, except for 2007, 2009, and that was right about here. So that was right about there. Prior to that, the the next, I guess, significant pullback we saw was in the of 1999. And we pulled back right down to from 1999 to about 2002, 2003, pulled back to the 50-day moving average on a quarterly chart. Okay. Notice how tight price action here, how tight, even though there was a pullback 2007, 2009, 1999, slight pullback in the overall market, looking at the quarterly chart. So that means a couple quarters in a row, several quarters in a row, the market traded downward. But remember what I just said in the beginning, that the 50-day, 200-day normally acts as price magnets. So price likes to stay pretty close to the moving averages. Even with these pullbacks, look how close, how tight price action is to the moving averages. Still pretty close, still pretty tight, even with that pullback to it. So in other words, price never got too high above the 200-day and the 50-day. It's still tight price action. Even 2008, 2007, 2009, we were not so far above the 50-day and or the 200-day. So we got that pullback, check back to the 50-day, through the 50-day on 2007, 2009, all the way down to the 200-day. Look at what's happening now. Look at this gigantic move after we had the COVID plunge, which is right here, and we got this gigantic move away from these moving averages. Look at the distance. You tell me which looks more dire, 1999, 2007, 2009, or where we are now. We are extremely far away from even a 20-day, which is this yellow line here. And then we are extremely far away from the 50-day and the 200-day. Now, price, unless these technical analysis changed over the past 20 years, price does not like to be so far away from the moving averages, even on the quarterly charts. And the longer term charts, to me, when they start to show some type of sign of a reversal, I pay very close attention, because you know, they're more inclined to you know, to be correct as far as the longer term outlook versus the shorter term time frames. So are we possibly setting up for a possible crash? That is a possibility, folks, because again, look in the past, as I drew these trend lines, we have never been so far away from the moving averages than we are now on the quarterly chart. We have not been that far away from the moving averages. So even if I was to duplicate this movement from 2007 to 2009, from the top of this move to the top, if we was to move that much, that would take us probably back to the 20-day at least. Maybe if the moving average continue to curl upward, we could possibly meet the 50-day here. That still would take and we're looking at the S&P minis right now. That still would take a price of the S&P down to just below 4,000. Okay. But that still does not even get us back to probably not even back to the 50-day, or not even back to the 200-day. Okay, now even take a look at the RSI, which is all the way down here at the bottom of my screen. RSI on the quarterly chart is still in the overbought territory. So you see with the oscillating signals or the oscillating line in the RSI is still well above the 70 level. It's still red, so we're well above the 70 level. So if this continues to trickle down, we could, you know, still have a long way to go before we even get down anywhere near oversold level. Okay. So could price action, because in 2009, when we got that pullback, look at the RSI. We went from overbought all the way down to oversold. Okay. So 2007, we were overbought, then we went all the way down to oversold level. 2009, and that's when we got a bounce. Looking at where we are now, we haven't even, on this quarterly chart, we ain't even dipped out of the overbought territory yet, with price action still at elevated levels, overbought levels. So there could be a long way down, folks, before we see the RSI get back down to the oversold territory. And that could take the bulk of this year for us to see that movement all the way back down to the overbought territory, oversold territory, or it could happen sooner than that. So again, price action act as a magnet to the moving averages. So again, see how far we are away from the moving averages. If the moving averages don't come up to meet price action and they start to, you know, stay flat or come down, we could see a move all the way down to around well below that 4,000 level just to get to the 50-day. And then if price continues to go down to the 200-day, that's an even bigger drawdown. So 2022 could be a year where we see some significant moves in the market from quarter to quarter. Each quarter this year could be not good. Look back to between 2007, 2009, or 2008, 2009, when the market started to have you know, create lower lows, or have every quarter finish in a downward trajectory, or every quarter finish lower than the previous quarter. We can count these red quarters in a row. So all these red candles here, that's 1, 2, 3, 4, 5, 6 quarters in a row until 2009, when the market started to reverse. Where are we now? We're just getting our first red candle. So could we have a terrible year in 2022? That is very, very possible at this point, with price action so far off of the moving averages. You got to keep that in mind on a quarterly chart. We are so far off the moving average. So we could start to have bad quarter after bad quarter after bad quarter until we meet the major moving averages, which is the 50-day and or possibly still to the 200-day. All right. And if I was to switch this to the Nasdaq, we would see the same type of setup. Same setup, same possible scenario could play out. Nothing's different, except for just a different index. And if we was to take a look at the Dow Jones futures, nothing different. Same setup. Well off of the moving averages. And if we was to look at the Russell, that's even a more telltale sign. And the Russell, it started dipping a little earlier. It's closer to its moving averages, so the Russell could find footing prior to everything else, but there's still a good distance from where the Russell is now down to its 50-day moving average. It still would have to go about almost 3,000 points down. That's a big move for the Russell. Over 3,000 points down to get to almost 16,000 in order to get to back down to where the 50-day moving average is at least. So I wanted to point that out, folks. And if we take a look at the VIX futures, interesting thing on the VIX, and we're gonna look at the VIX from around that 2007, 2009 level to where we are now. So look at the VIX back here between 2008 and 2009. See how the VIX got that nice little spike up. When VIX started to spike up in 2008, it reached the overbought territory in the RSI rather quickly. See how down at the bottom of RSI, we are definitely in the sold territory. Got there pretty quickly. All right, and the Williams percentage, the Williams percentage and the full stochastics were also towards that overbought territory, but didn't quite reach it. Now, fast forward to the day. Right now, the VIX on a quarterly chart is showing an oversold territory on the Williams percentage and oversold territory on the full stochastics. RSI is just hanging around in the center. So with the Williams percentage showing oversold, full stochastic showing oversold, and we're starting to get a big green candle on this quarterly chart for the VIX at a level of support. So could the VIX be in the process of reversing and making a longer term move up, continuous move up on a quarterly chart? That is a possibility, and that's what I believe. Now, so with that said, again, you cannot ignore the action in the longer term charts, and you cannot ignore how far we rallied on these major indices after that COVID reversal back in 2020, and a quick rally, how we rallied multiple quarters in a row and steep rallies off of that bounce, off of that 50-day moving average, well above the moving averages, and now we're just hanging out here. If I was a bet man, I'd say we are going to get a check back to these moving averages on a quarterly chart this year. What else leads me to believe that we could be in store for a possible crash? Again, we are well off the moving averages. We can see it move right back down pretty quickly. Another thing that leads me to believe is check out this tool. Here's the Wall Street Journal's market report. And see the date here as of 4:15 p.m. on 1/21/22. And this is the stocks within the New York Stock Exchange. It shows you, it pretty much gives you pretty much a good idea of the synopsis of the market or the breadth of the market. So it shows you at that particular time frame how many 52-week highs were showing. 8 stocks were only A stocks were showing 52-week highs. So let's scroll down and see how many 52-week lows we were showing. 526. That is a big lopside, folks, which tells you that the overall market is skewed towards the downside. All right, what about the Nasdaq? Let's take a look at the Nasdaq. So let's switch. Let's click on the Nasdaq. Voila, 52-week highs. Awesome, 22 52-week highs during that time, during that day on Friday. Let's scroll down. How many 52-week lows? 1,323. Folks, if this does not scream crash or scream bear territory, I don't know what else does. 1,000, that's almost 95% of the Nasdaq is starting to show 52-week lows on Friday, reaching new 52-week lows on Friday. If that doesn't scream big bear or big crash, I don't know what else does. All right, just wanted to point that out. Hopefully there's some information that you guys can use while you're going through your trading here and the rest of the year. And I wish you all the best and wish you all great luck. Until my next video, this is Tim Davis signing off. Enjoy the rest of your day.